Hello, folks. Brandon Chapman with you today. It's the Thin Night video for April 11th, 2022. Interesting day in the market today, down 1.66%. As you notice, we're approaching that 50% retracement off the rally over the last few weeks. So we'll see where we go. I mean, is this the beginning of the end of the bullish kind of short covering rally we saw for a couple weeks here? Or is this just a little rest stop on the way to another bullish move, a leg higher? A lot depends on this upcoming earnings season. A while ago, I did a session talking about the three bears, one of which was earnings upcoming and the potential for earnings downgrades. And so we think about today's title of the session, Banks on the Earnings Deck, as energy is behind an account. Strikeout? So the question being, do banks and energy strike out? And we'll kind of look at that as we look at some various areas, some unusual option activity, and a number of various symbols to that regard. So, we look at today and you see the decline. One of the first things you want to check is, well, how much did the VIX go up? I mean, did we see any sort of panic today? Normally, you'd probably see a big move in the VIX if you get a, near 2% decline in the market. You'll notice we're up very little, up to about 24. You'll notice how we found 20 as support. Yeah, we went down as low as 18.5, but around 20. This area typically acts like support or acts as a level of support after some of these shocks where you have these more capitulative type of events like we saw the last couple times the last month. You'll notice these previous spikes. It comes down to, in this case, about 24. We eventually grind to 20. We grind to 20 after these shocks towards 40% on the VIX and move here to about 30%. We pulled back, stayed around 20 for a little while before bleeding down. Again, here we saw a big spike. We came back to 20. Here we stayed at 20 for a little bit before grinding it out a little bit lower. It's certainly possible that we may see this grind out further, but one of the things that we're watching here is that the VIX does peak at various levels and troughs at various levels. But right now, 20 should act as level support, which is relatively bearish for the market. But if we look at VIX 3M plus VIX, we also have this indication back here. It was on March 28th that the VIX was relatively low compared to the 3-month VIX, meaning what? If you look at the values over here, 1.2, the 3-month VIX was about 20% higher than the VIX. Right now, it's about 10.8% higher. So despite the selling today, we didn't see this really come down below 1, which is a better indication of a potential area of support like we saw in January and even most recently in February, early March. If I bring up my dates here, we kind of crossed that late February, began to come out of it in first week of March. And this is where we saw that short squeeze that drove it back up to above 1.2. Another thing you can look at is things like skew, for example. Did skew decline? And when we say decline, did it come down to very significant levels that would be constructive for the market, that would uncap or open up the upside potential down here about 115, 120? The answer is no. The selling barely trickled it below 130 before heading back up again. And we've been generally in an uptrend since February 7th, despite the fact the market, generally speaking, since February 7th up here, for example, has been generally weak with this rally right here. So the point being is that the skewed nature of market returns are still being priced in. That downside risk, maybe with a higher frequency of small up days, obviously get these bigger moves here coming off that short squeeze, and then it inches, and then we start to see the correction. But the fact of the matter is, we may very readily see the market back at 420. The only question is a matter of what is going to change the trajectory. As you look at today's performance on the day, energy was the weakness, followed by technology. The S&P was down 1.7%. Where were financials? Down about 0.5%. Now, financials are a little bit different in that they've had a more bearishness of late. They're further into their decline here. We saw a pretty significant downdraft here the end of March. But with earnings season coming up, what does this mean for financials? So, for example, the first to really hit here is JP Morgan. And this is coming up on the 13th. So today's the 11th. So we got on Wednesday, we're going to see earnings coming from JP Morgan. And really, this is the only of the major banks they're going to be announcing. Citigroup's on the 14th. Goldman Sachs is on the 14th. Wells Fargo's on the 14th. Morgan Stanley's on the 14th. And Bank of America is on the 18th. So coming up next week. If you consider maybe some major regional banks, like, for example, U.S. Bank. U.S. Bank is set to announce on the 14th. So we're really going to see a lot more on the 14th with regards to banks' earnings. And the question is, well, is it going to be good, right? Well, here's the deal. I mean, the last earnings, we saw, a steeper curve. And guess what happened? Banks actually declined. If we look at, for example, TNX, the TNX, however, for this quarter was down here about less than 1%. That's a 2020. Sorry about this. Last quarter was about 1.5% probably average. This first quarter here, it's a bit better at maybe 1.9%. But when you think about interest rates and IRX is creeping up here as the Fed was expected to raise rates. So spreads were potentially better, but what it comes down to is a couple of factors. Number one, we want to consider in this earnings, what is the net interest margin? Meaning, what are they making, right? Off of the loans that they're making. Bond trading was a big deal and a major negative in that last point back here, for example, when JP Morgan had that gap here. Bond trading was way down. When you consider, for example, net interest margins and income, right? How much are they making on the spread on loans? And certainly we've seen some increase in the spread between, corporate credit and the federal government, what they're able to borrow at. That risk spreads. Certainly borrowing costs for individuals are going up as well. But what are banks going to do in terms of pulling money out of loan loss reserves? Meaning, are they going to pull more money out to boost their earnings like they did back here? Or do they actually put more money aside in case there's more loan losses? We'll have to see. There's a lot of uncertainty going in here, and there is the potential that bank earnings do come out relatively negatively. Last week, there was some bearish trade in XLF, 29 April 34. So if we bring up XLF here, but we could counter that with the trade today in terms of unusual option activity on a 22 March 40. So here's a 40 strike up here. So we come in here, go to trade, look at 22 March. You'll see out here at the $40 strike price, 18,000 contracts mostly bought. So again, there's an indication, maybe some bullish expectation built today, maybe off some of the weakness. $40 is way up here for an expiration that's set to end next week. So we got basically 2 weeks of trading left. And again, that's a relatively big move. But if the most recent selling in banks end up being relatively pricing in something that's not going to happen, meaning your bank earnings are better than expected, it would certainly be reasonable to see JP Morgan maybe gap up here to 143, 145 if the earnings come out much better than expected. Because of late, we've been pricing in a rather negative expectation. And when you look at the expected move for this week, it's plus or minus $6, $5 on the market maker move, which accounts for the difference in implied volatility here. So we're talking $5 to $6 one standard deviation range. This is a $10 move? It may be possible if they come out and beat. So rather than trying to guess, and certainly you can do trades. You could throw a butterfly out here potentially, just kind of targeting that $6 move, for example, at 139. And if we get close to highs, you probably make money. You could do an in-out spread, buying one in, selling one out, expecting to see a move. You'd probably do both of those tomorrow before the close, because we're going to announce before the open on Wednesday. You could do like a butterfly to speculate a low cost, or maybe an out spread just expecting it to go higher. But the reality is the earnings themselves are probably going to tell us more about the state of banking and future expected earnings. The fact of the matter that the Fed is expected to raise rates significantly this year, right? /ZQ. We look out here at December, for example, we're talking 97.5. We're starting to price in basically 2.5 to 2.75% Fed funds rate. And right now, we've raised just a half a point. Quarter point. Expect to raise a half point in May. This is going to happen really, really quickly. And when you consider where the TNX is right now, we're at about 2.7%. Any weakness in the market could readily see yields start to come in today. And again, we're talking about a Fed funds rate that's pricing in between 2.5 and 2.75%. So we're running a little bit outside of that right now, those expectations. But the reality is, as the Fed begins to engage in policy and quantitative tightening, this could be really negative for stocks. And the only silver lining that people have, generally speaking, for the market is that the Fed cannot get there to 2.5%. Can they make it to 1%? If you look at IRX, this is a graph of the 3-month T-bill, which generally follows the Fed funds rate. Again, pricing at about 68 basis points right now. Again, can this get to 2.5%? Boy, there may be a lot of people betting that's not going to happen, and in which case the market does potentially sell off. But where is that going to come from, right? I mean, we're talking about potential inflation issues, supply disruptions, etc. We look at oil today. Oil's down about 3.3%. Energy stocks were down 3%. That's kind of a big deal. However, I mean, what is the risk here? Is the risk to the upside still where maybe 150 or 200's on the docket? Or are we going to come crashing down to 65? Again, the supply side is not going to be solved anytime soon. It's going to come down to demand, meaning that is there enough demand destruction due to higher prices and maybe the tightening policy starting to bite on the economy, maybe even getting negative GDP in Q1 for this year? Does that start to kick in? And when you look at, for example, the supply side's not changing, the demand side may be, if you consider what's going on in China and the shutdowns there, for example, look at how the curve has changed over the last few weeks. It is really the red line represents today, and this is March 18th. We could change that here. Let's just change it to last week. We're talking the 4th. We'll change that to 28th. And look at what's happened here, right? So this is, that's the 28th of March. We've got the 4th of April. Now we're talking the 11th of April. Look at how the curve is flattened. There's a lot of uncertainty starting to build right now. We're still in backwardation, meaning prices are falling as you go out, but the risk is still a little bit to the upside. But it has really diminished over the course of the last few weeks, 2 weeks to be exact. And we're at a key level support right now at 95. Now, again, I would still suggest we still have these upside risks, but those upside risks are diminishing. If we can get through this April expiration, if you look at /CL, you'll see that, there we go. The active contract expires in 9 days. That may roll over the next month in June and by 8 days expiration, maybe by tomorrow, the next day. So what we have here is a scenario that we still have to deliver on this contract. And this is the one wrinkle with a lot of commodities. Can these companies that sold these contracts, can these suppliers deliver? Right? Is there risk to actually being able to deliver product? There's been those that have called out, we got to bail them out just in case things go awry. So again, I think there is the upside risks here, but because supplies are so small, but the demand side of it, this shift in CL certainly appears to say that the demand outlook is changing, and that's generally going to be bearish for the market and bearish for earnings as well, by the way. If there's lesser demand for product, people are going to buy less, travel less, spend less, etc. You'd expect and buy fewer widgets, right? That would expect to be a relative negative for the broader market. Now, Don put out a bullish in-out spread trade on SLV last Friday. It was up nicely today. Did fade from our high a little bit. Gold was up as well. It's one that I was talking about in my sessions about bullish activity in GLD, or specifically Kinross Gold KGC and GDX. They all kind of popped today. Now, again, this doesn't really, normally you see the market sell off. The dollar should strengthen in real terms. If we look at UP, this is relative terms to like the euro. The dollar didn't do a whole lot today, right? Up a little bit vis-a-vis the euro and other major currencies, but the dollar, in fact, lost value today as a result of the fact it was down against the dollar. Look at Bitcoin today. Bitcoin was down nicely, about 7%. And this is just reflective of the fact that Bitcoin has not found its footing, that the paper market, the speculators in Bitcoin are still in there creating a lot of volatility. So it makes it difficult to establish that store of value that's so needed if something is going to become money. But again, there were some bullish trades last week in gold that I talked about during my sessions. Again, Don put on a bullish outspread on Friday, looking for upside here. Now, this is a tenuous amount of upside because if the dollar begins to strengthen, which we are in a very unique position in a stagflationary environment that could be very favorable for precious metals. Today, it was AG. So First Majestic Silver Corporation was up and kind of faded back a little bit. But off the open today, it was a 29 April expiration out here at about the 1550 strike price. Again, mostly bought. This structure actually favors even doing some sort of vertical spread, buying here, selling there, for example. If you're trying to speculate on the price of AG, you may even go out a little bit more time, maybe do like a May contract, a little bit better liquidity out here. You still get the rising volatility. This is called skew. In fact, I have a mastermind coming up, and this is a beginner's one coming up at the end of the month for 6 weeks, where we really delve into the foundational elements of options, the Analyze tab. We go over some investing plans for various strategies from verticals, like the in-out spread, for example, gamma iron condors. We go into like earnings trades using calendars, for example, butterflies. And again, just to give you kind of that kind of foundation and some plans to get out there and execute in the market. But anyway, that's coming up at the end of the month. You get it to TheoTrade.com/OTM/ if you want more information on it. But anyway, so as we look at First Majestic Silver here, again, there's that out of the money presence out here expecting some upside. And that's one of the things we continue to see. Very bullish expectations, which is interesting because, again, normally the dollar should gain in value right now. But with $5 trillion, a $9 trillion balance sheet, $5 trillion being added to the economy in the last couple of years, it certainly puts the market in a very difficult position. How does the Fed absorb this? If you put out $5 trillion or increase the monetary stock by $5 trillion, when you think about reserve balances in on-demand deposits of 10%, that $5 trillion could expand to as much as $50 trillion. Now, I'm not suggesting that the mechanism for banks to do this kind of expansion is there. Obviously, we probably fell well short of 50 trillion. But again, these are orders of magnitude, right, that we just never seen before. And as a result, there is that problem that the Fed may raise rates and it may not take immediate effect. It may take more time, more aggressive policy. It's something that I wrote about on our blog a couple of months ago, talking about the need for the Fed to shock the market, right? This is when you see inflation expectations being baked into the cake of expectations of consumers, they need to shock them. And that's exactly what they're maybe poised to do here, is to shock and change the trajectory and really start to stifle, initially maybe going to cause them to kind of pull back and create some pullback on demand and create potential value to step back out there, have a willingness to take on debt and spend money again as prices come in. We'll see. But again, that may happen sooner. That's why you're seeing such huge trades this year in precious metals specifically, along a lot of them kind of by summer to late this year, early next year. But again, there continues to be some bullish trade in here. Again, not a lot of immediacy to create higher prices, but there is that possibility that what if some of these foreign governments that are holding on to dollars, China, Russia, right, these dollar reserves, what if they need to defend their currency and they basically exchange dollars for their domestic currency to support it? There could be a supply of money coming on as a result of some of the policies that we're engaging with right now that may create a kind of an upside down environment where maybe yields go up, the dollar gets out there, it's diminishing in value, and the markets go down as well as the economic outlook stalls. And while that may not be the most likely scenario, it is a scenario that some people are likely potentially trading on right now. While not exactly a precious metal stock, Rio, for example, today had a very nice rebound, retest the prior high. We're maybe forming kind of a flag formation. Volume is relatively low. Probably look for some sort of breakout here, maybe some close above the high from yesterday, for example, or maybe today's high as just an indication. Again, it's probably a little early, but This May expiration was traded today, 3,800 contracts, mostly bought at the 85 strike price. Again, some bullish activity coming into Rio today, expecting a continuation in this move. And again, go look at the strike price, 85. We're looking at potentially a retest of the prior high from March 3rd. And maybe, just maybe, we break out beyond that point as we start to move back towards a 95.61. This was a fib projection I did here. You can see it hit the 261 and reversed. Now you're looking at it going the other direction. So again, here's kind of your, from a longer term perspective, your seed wave. And again, I mean, 90, 91 to, certainly 110 is not out of the realm of possibility here. So again, this is kind of maybe saying, hey, we get to 85. We may see this ring run back to 90 to maybe 93. So anyway, so keep your eyes on Rio. On the bearish end of things, again, we're talking about financial. One financial stock that's more on the consumer credit side. And again, one of the difficulties with American Express is that they hold on to the credit, right? They're not just, out there doing transactions like a Visa, for example, right? In this case, American Express is the bank. You'll notice we tried to bounce yesterday. We failed. We took out the low today. And you think about this, say, okay, there is downside here, clearly to 155. That's what happened the last time we were in this position, for example, in late February. But sometimes you might say, well, yeah, we've moved down so much. How do you balance this out? This is a great example here. So we look at a May expiration on American Express. You'll see the 160 being bought, the 145 being sold. Notice they're buying the 42% implied volatility and selling the 50%. So this is a relatively cheap spread, costing you about $1.60. And, look, it's a 15-point spread. So you risk $1.60 to make what, $13.40 if we can get back to 155 by expiration? That may not be a bad deal. And you notice here it's 39 days out. This could unwind very, very quickly. And that low risk, high reward, low probability trade is one way to take risk without taking a lot of risk, right? To have the upside if there is a sell-off without taking a lot of risk in the trade. When we talk about oil today, so OIH is an oil service company. Generally speaking, these companies would benefit if there's an expectation or the companies are actually expanding output or production. 2 weeks ago in the oil inventory report, there was an indication, maybe a slight uptick in production, but for the most part, production is not increasing at the same rate we probably need it to. And if the demand side starts to come in and prices start to fall, this could be a relative negative for OIH. And so while what we saw in terms of oil, it's not a bearish indication to get out there and short it, but it's certainly one where you might begin to take some profits in some of these companies because the risk is there. Leave a little bit on the table just in case things break out this month. But in this case, it was an April expiration. So we look at the put side, April, scroll up here. The 275 strike, 4,000 contracts against 4,300 open interest. So we're closing out the 275 there. And what's happening is they're actually, in this case, they're buying a July expiration and stretching out a little bit further to the 245 strike. So again, it's not exactly an overtly bearish trade, but it's leaving some money on the table. You're actually requiring a little more extra skin in the game here since they're closing that out for $1.90. They're buying that for $11 for 2,600 contracts in one print. And that's a sizable amount of money that's been in one trade. It's not a retail investor out there trading it. This is an institution that's looking at potential downside. You might say, well, maybe they're hedging. Doesn't matter, right? It's the timeliness of what's happening right now. So again, I mean, some cracks in financials in terms of AXP and OIH in the energy space. IWM today, IWM has a big representation in financials and energy as well, for example. But as you look at IWM today, it was one trade that stood out in particular in IWM. It's kind of a crowded a market for a stock like this, for an ETF like this rather. But it was a 22 March. It was right here, 18,000 contracts traded at the 190 strike against 2,000. So that's opening activity. Again, you can try to kind of analyze and break it down, and it's one where it's a little hard because there's so much going on here. You could just look at puts. You could just look at the 22 of April in here. You'll see one tranche bought there for 8,600 contracts at $147. Then some other stuff, mostly buy side filtering in. So again, 192 is here. That's about where the support is. If we take that out, it's going to create more gamma pressure to the downside and a lot of these names out there that represent IWM. Boy, time's flying when you're having fun here. So another company I want to take a look at here is Deutsche Bank. Again, this represents the financial space. It's not a great bank. It's had a lot of issues. Today, you had a very massive engulfing pattern. There's a lot of gaps because predominantly trades in a foreign country, and so it trades there, then it opens here, and it has to adjust. But it's a big day on some major volume in Deutsche Bank. And there's a 22 April expiration. So again, 11 days out, 6,900 contracts traded, mostly bought at the $12 strike price. Again, just reflecting a little bit of bearish interest here in financials, and particularly a bank that's been problematic or has had a lot of trouble in Deutsche Bank. KRE, I mentioned U.S. Bank earlier. That is a regional bank. These companies focus a lot on lending. Notice the underperformance of KRE here, already taking out the March low. We tried to rally today. We faded back. And by the end of the day, it was a May 62.57. So we're going to go into the May expiration here. So you got a 57. So notice that's less than the open interest. We're closing that out, rolling it up to the 62. They're doing it at a debit. So again, what's happening? They want to become more connected here right before earnings week to say, hey, they think there's downside in KRE. Doesn't mean they're right, but this roll certainly is representative of some bearish indication or expectation with regards to KRE. And again, look at the strike price involved in here, 57, raising it to 62. 62 basically gets us back to these prior supports. So that might be the expectation for the next couple of weeks to see this break down towards 62. Of course, that would require some bearish news from companies like U.S. Bank today. But, a downside spread, go back to KRE. But a downside spread, instead of like just buying a put out, you can even just what? Buy a spread, right? Buy the 29, sell the 36, right? Buy the 29, sell the 35. Looking for downside activity. Spreads on here are kind of wide. Obviously, this is actually not a great product. Maybe it's just the close. There's a lot of open interest here. This should tighten up tomorrow though, but maybe even a spread trade, buying and selling, looking for downside, even just like an in-out spread, buying in the money, selling out, just looking for a small down move by the end of the week in KRE. Finally, we're going to wrap up here with CHPT. So CHPT, this is one that earlier in my session this morning, we're going over some scans for unusual option activity. And one of the stocks that came up is ChargePoint. Notice the sell-off here. We had some higher volume. Today was a relatively neutral candle called a spinning top. If you look at the pullback, the retracement here, we did break through the 61%. There is risk that we go back and fully retrace back to 1424. So you might want to look for an upside trigger at around 17. But if we look at if you're bullish on CHPT, however, today's activity was actually bearish. So if we look at the 22 April, and this happens sometimes, right? Where you get a stock that's down, you're thinking bullishly. In reality, the market's thinking bearishly. So you might look for a little follow through, maybe through today's low to go to the lower, but notice it's a 16.14 that was bought today, buying 86, selling 94% implied volatility. Costs, in this case right now, about 55 cents on a $3 wide spread. And all this thing has to do is go back to 14, which is right here. By expiration in how many days? Only 11 days left. So there's a lot of gamma here. If this pushes through, it's going to work to really maximize the delta exposure and wring out that extrinsic value, push it towards max gain relatively quickly. If we can get any traction here below 14 as we push towards 12. But again, this is a company that looks like we're maybe setting it bullishly, have a little crack right here, but in reality, the market's expectations, this thing rolls lower to 14, maybe even lower here in the next 2 weeks. All right, folks. Well, that's the end of our session today. We'll catch you back next week on when I do the Monday video. Of course, we got one coming out every day this week from Don and Corey. Hope you have a